time to get into the advisory now, and particularly focusing in on the privatisation of wealth. Andrew Whelan from Dash Technology joining me. What have we been seeing? A lot of M&A activity here in particular.
We have. We've been seeing, and one of our consulting groups has coined it the privatisation of wealth. And what that means is investment platforms, which have been, Hub and Net Wealth have been some of the top performing ASX stocks over the last calendar year in 2024. A lot of their competitors have been attracting investment from large-scale American PE firms, and this is all happening right now. So where they used to be owned by banks and institutions like Colonial and IWF, or Insignia as they're called now, very shortly there's going to be a real privatisation and they're going to be owned by PE firms. So for instance, Mason Stevens, which is about $10 million platform aimed at high net worth. They're also an advisory business. They've been taken out completely by a business called Adamantium. KKR in 2021 took a controlling interest in Colonial, and then there was some press late in the Australian in November 24 that while they were in 21, they're also looking to get out as well in 2025. So there's a data room up for CFS. And now Insignia, or the old IWF, 180-year-old advice and platform
the bidding
business.
Platform just keeps going here.
Just keeps going, right?
Yeah.
And so, and even of note, there was 3 massive American or offshore PE firms bidding for them. Brookfield has just pulled out today, notably. But in either case, it looks like Insignia is going to fall into the hands of an offshore PE firm as well.
So what is the implication of this then more broadly?
Well, more broadly, it's really fascinating, and there's been some research on some of their listed peers that's come out recently, where whenever you have a massive ownership change, it's really clear, and this has played out. So platforms have been around since the 90s, and so what happens is changes of ownership is destabilising, and it will have a short to medium term impact. And it just has to, and often does, on FUA, like net flows, and then performance, because of just advisors don't like change, right? But overall, these businesses having an increased capital base is a good thing, in that it'll be good for the business, it'll be good for investors, it'll be good for Australians that are getting advice. But overall, it's going to be destabilising in the short to medium term, which means that, and the research is already suggesting that it means that the people who are already sort of winning this platform race will continue to do so in the short to medium term.
Is it good for Australians if we have companies going offshore though?
Well, it's probably not good for trade, for the trade deficit, but if you are... a lot of these businesses were sort of hurt from reputationally over the Royal Commission and have changed a lot. So IWF, for instance, was one of the largest tied distribution networks or tied advice networks in the country. They've recently restructured so that advice is more on a service basis rather than an ownership basis. So they're largely a platform and funds management funds management firm, and those businesses need capital to continue to innovate. So I think for people who are big supporters of these businesses, I think in the medium to long term, this could well be a good thing in terms of getting some capital behind them to fund innovation, but proof is always in the pudding whether or not that capital translates to performance.
So then with your crystal ball, what do platforms look like in the future? And you touch on innovation. We've talked about AI adoption as well in the past.
We have. So specifically with platforms, what we're seeing is, and the history of platforms is a very straightforward one, where they kicked off in the 90s because advisors were historically having to write application forms to 7 or 8 different fund managers to create a diversified portfolio. They could never get a centralised place for reporting, so that's a platform. These days though, what we're seeing, and Dash has recently invested really heavily in the non-custodial space, is what we're seeing is wherever advisors have used a platform, they have 1 or 2 other platforms in their same practice. So platforms have never really nailed the efficiency, the efficiency solution as having 1 platform in the practice, which was sort of the whole idea in the beginning. It's with 2 to 3, they've never nailed that. But with clients that we're working with now that we've invested so heavily in non-custodial, the planners we're speaking to are managing just as much money off-platform, around private debt, private equity, over-the-counter bonds, anything sort of esoteric, often a lot of international stuff that isn't necessarily listed, cannot be managed on the on the typical or traditional custodial platforms.
Yeah.
So what we're going to see is, I think that platforms will be both custodial, listed, managed funds, all that traditional wealth assets, but they're going to need to be able to provide a more holistic solution to planners.
Before we let you go, it is a very volatile time at the moment. Yeah, it is. I don't know if you've noticed. But so what are we seeing in terms of overall investment themes and how people can kind of navigate this?
Well, I think on a similar note, what we're seeing is managed funds, were always dominated historically the advice sphere. Everyone always said managed funds and insurance, they're never bought, they're sold. But not to say that they're without value, but I think what we have seen is the peak of the usage of managed funds in the industry, and I think that bears out in just the sheer comparison of net flows between ETFs, which last year was something around the $35 billion mark, whereas Aussie equities, and it's not necessarily apples for apples comparison, but Aussie equity managed funds only raised $380 million between them all last year, and that's a turnaround from negative number. So I think the traditional managed funds we've reached their peak, which means that advisors, particularly in choppy markets like this, they're going to be looking towards more alternative investments to be able to try to generate some returns for clients, and they don't necessarily fit neatly in the traditional custodial platforms. You need to look for something a little bit more innovative.
Be nimble, in fact.
Indeed.